Thank you. So, golden rule of speaking is when you're a middle-sized VC and somebody predicts the death of middle-sized VCs, speak second. As you'll see, Scott and my slides are pretty similar. I'm just going to have a slightly different take on very similar data. So I'm going to talk about the shift in the VC landscape. And when I take this out, I'm not checking email. I'm keeping time because I didn't wear a watch. So 2014, if you're an LP in this room, you're probably feeling a little bit burdened. Every LP I'm talking to these days is saying they haven't seen so many firms in the market, so much demand in the market since the recession. So LPs are pretty busy. And all these slides I'll make available, so if you don't want to take notes, feel free not to. So my message is the dot-com skepticism that emerged from LPs investing into VC land is thawing. I would even say that it's over. And there are some things that have changed. The first thing that's changed, everyone intuitively knows. Here's the data. 67% of all new funds raised are less than $50 million. 67%. I have argued for a long period of time that this is driven mostly by the massive decrease in costs required to launch a company, mostly driven by Amazon, by AWS, but also by open source computing, horizontal computing, and so forth. Just so you know, it only represents 6% of the total capital, though. By definition, these are small firms. Late stage funds, meaning $500 million or up, represent 66% of all capital. And you can see the trend steadily since the recession going up. More money is being concentrated. And traditional VCs, if I give us a nicer term, are down massively. Massively in terms of number of funds, massively down in terms of dollars raised. So yes, I think it's fair to say the VC landscape is shifting. I'm not ready yet to call us Kmart. There are some obvious factors that are driving this. One is you have pension funds and very large asset managers that simply need to write $100 million checks. And last time I checked, Dave is crowdsourcing $100 million. So if one LP came in, he would have LP concentration risk. The second thing is fund of funds. If you don't know what a fund of funds are, they typically raise money from incredibly large investors. They break up the capital into smaller bite sizes, and then they invest in VCs and private equity and other asset classes. And the way that fund of funds raise money is having access and insight to managers, meaning VCs, that a huge pension fund wouldn't have. Well, if you're selling access, you better be in access funds. And so they also want to pile on to the winners. And so you have this narrative, this perception that I would describe as the best and the rest. The problem is, number one, the best and the rest is not that obvious. You have a term called an emerging manager. Let's name some of them. Union Square Ventures, Foundry Group, First Round Capital, True Ventures, Greycroft, Spark Capital, Upfront Ventures, and even Andreessen Horowitz, as successful as you've been, is a name that 10 years ago didn't exist. So if you're being defined by access, the question is, what does access mean anymore? But my view of this is too simplistic, and it's really changed a lot. And I am actually going to use this slide with the word bifurcating in it. I tried really hard not to. I just couldn't think of a better word. The market is bifurcating. And what's really happening is startups are staying private longer, more value captured by private investors, and VC funds, middle-sized VC runs, are not disappearing, they're changing in structure. Some of them are simply getting bigger and collecting more assets, But some of them, and I've listed those, some of them are either doing growth funds or opportunity funds. An opportunity fund means I get to take pro rata if I funded Pinterest, Uber, Dropbox, Airbnb, rather than the value being captured by somebody else. And the economics of these opportunity funds are often better for LPs. Companies are raising larger amounts of money. This is the median amount raised prior to IPO, and you can see that's going up. We've talked about new people entering the market. I really see it on 3 different spectrum. On the right-hand side are hedge funds, mutual funds, non-traditional investors who are moving into the market and writing large checks. But let's not forget Google, Rakuten, Alibaba, Tencent. Tencent just did a $768 million deal today. I think the company's called 58.com, and bought 20% of it. So that's driving up prices dramatically. And then traditional VCs have growth funds and opportunity funds. IPOs are happening, they're just delayed. And importantly, and Scott talked about this, the value capture is happening as private companies. So on the left, you have Cisco, Amazon Mobile, Microsoft, and their IPO value and their current market cap. On the right-hand side, you have the market cap of LinkedIn, Twitter, Facebook, and estimates for Alibaba. So way more value is being captured in the private market. No wonder T. Rowe Price and Fidelity and people who are investing in IPOs want to get in earlier. It's not 2000 though. I have written a whole presentation which I gave in part last year called It's Morning in VC. And what I meant was there was a Kaufman report saying VC is a terrible asset class. And I said it is a terrible asset class if you're looking in the rear view mirror. Because when the bubble happened and the Kaufman report data, we had 50 times less users, 120 times less online speed, nobody had smartphones, nobody was socially connected, and nobody had credit cards on file. So the winners get much bigger, much faster, and create much bigger opportunities. So I think the Kaufman report is a wonderful assessment of what happened and a terrible prediction of what will happen. Public companies today, the left-hand side is years to IPO has more than doubled since the dot-com bubble. Revenue going public is more than triple, and valuations are less than half. So it's a much more rational market than it was before. But here's the problem. The problem I would define as this. The orange line being traditional VC, today's VC, and the blue line being historic VC. And if you look at the blue line, it used to be the first check was $5 million, the second check might be $15 million, the third check might be $25 million. And because you've dramatically compressed the amount of money created to do a seed round or an A round, you have much less capital going in early, which I think is great. I agree with what Sam said. I agree in capital constraints in early stage. But then there's so much pressure to be in the ones that are working that you have this massive piling on of capital in the ones that are actually working. And I think the same problems we saw in Sam's discussion are happening now in late stage financing. So here is, I think the last slide, if I remember correctly. Here is the valuations by round. And what you can see is seed rounds are up about 17% over the last 4 years, A rounds 14%, B rounds 9%. There hasn't been a huge increase in early stage valuations. Series D is up 24% and rising. And it's rising because you have less price sensitive public capital investors getting into the market. You have significantly less valuation sensitive corporate investors, big tech companies, Alibaba, Tencent, Google, Rakuten coming into the market. And because traditional VCs with their larger funds that have growth and opportunity and want to keep their pro rata are continuing to participate. This is what worries me about the industry. Thank you.